Wall Street has always sold a simple promise: that the smartest people in the room keep the system running. But buried beneath the marble floors and polished glass towers lies a different truth. One stitched together by quiet bribes, erased emails, falsified ledgers, and billion-dollar losses that never reach the headlines. Every financial empire is built on stories, but some stories are buried so deeply that only the consequences remain on the surface. For decades, scandals on Wall Street were not accidents. They were strategies, hidden, timed, engineered, and every time one was exposed, the system survived not because it corrected itself, but because the people who truly paid the price were never the ones who caused the damage. If you want more stories like this, consider subscribing. It truly helps the next chapter. Behind every collapsed fund, every vanishing CEO, every mysterious market swing, lies a pattern. Powerful firms shielding one another through silence. Quiet settlements, midnight shredders, offshore folders, a network so disciplined that failure becomes invisible and truth becomes optional. But the human cost never disappears. It lingers in pension funds wiped out, homes lost, savings evaporated, retirements erased. And most Americans never realize the scandal that ruined their lives was not a lone mistake, but part of a financial architecture designed to hide its own crimes. The mysteries run back further than anyone expects, from old Wall Street families who controlled early stock pools, to wartime profiteers who used global chaos to rewrite market rules, to modern algorithms engineered to manipulate price movements faster than regulators can blink. The question is no longer whether Wall Street hides billion-dollar scandals. The question is how many remain buried and how much has already been stolen in the spaces between the headlines. To understand how these scandals stayed invisible for so long, you must begin with the architecture behind them, a network of incentives, protections, and silent agreements that formed the real operating system of Wall Street. Contrary to the public story, oversight was never designed to prevent wrongdoing. It was designed to manage it quietly, to contain the damage before anyone outside the circle noticed. Every major scandal followed a predictable pattern. The fraud grew slowly, unnoticed at first, shielded by complexity. A trader manipulated valuations. A bank overstated liquidity. A hedge fund hid losses offshore. The first warning signs showed up in internal emails or discomfort in junior analysts who sensed something was off. But the structure above them was built to suppress alarms, not elevate them. When the truth threatened to surface, the machine activated. Lawyers negotiated non-disclosures. PR teams crafted narratives. Regulators found reasons to delay. Auditors lost key documents. And behind every settlement, there was always someone who knew more than they said. Someone who signed off. Someone who looked away. The reveal is simple but devastating. These billion-dollar scandals were not hidden because they were brilliant, but because the system benefited when they stayed unseen. Silence was a currency. Protection was a favor. And every institution understood that exposing one scandal risked unraveling many. The victims rarely realized what hit them. They saw their portfolios shrink, their pensions weaken, their savings dry up. They blamed the market. They blamed luck. But the truth was more precise. Their losses were collateral damage of scandals designed to protect those who caused them. When you follow the trail far enough, you discover that these events were not errors. They were business models. And the deeper you look, the more you realize that what Wall Street feared most was not the scandal itself, but the moment the public finally understood how many of them were never supposed to be found. Long before the headlines, before the bankruptcies, before the televised hearings and broken promises, the heart of Wall Street built its influence on a simple idea. Information was power, and secrecy was profit. This dynamic did not emerge in the digital age. It began in the earliest days of American finance, when market pools and private clubs silently shaped the economy long before the public even understood what a stock certificate was. In the 1920s, insider groups manipulated prices through whispered agreements passed in smoky hotel rooms. They rigged markets by coordinating trades, pumping shares, and dumping them on ordinary investors who believed the rising prices reflected something real. The victims had names, faces, families, and all of them trusted a system that was never designed to protect them. These schemes were early versions of scandals that would repeat for generations. When the market crashed in 1929, the public blamed greed. But the truth was buried deeper. Hidden loans, falsified books, and private deals had inflated the entire system. And even as millions lost their savings, the institutions responsible quietly escaped with their fortunes intact. The patterns forged then became templates reused again and again. By the 1970s, a new era of scandal bloomed. Corporate raiders, shadow banking networks, offshore partnerships. Deals grew more complex, documents grew thicker, and the paper trails grew longer. Each step added another layer of concealment, shielding wrongdoing behind complexity the public could not decipher. The game was simple. If no one could understand it, no one could question it. The 1990s brought global finance, derivatives, and computer-driven trading. With them came new opportunities to hide risk behind algorithms and models written by people who themselves barely understood the consequences. Scandals multiplied, rogue traders, mispriced assets, swaps that no regulator had the tools to analyze. Each time a major failure surfaced, institutions claimed it was unpredictable. Yet internal memos always showed warnings ignored months or years prior. But the most revealing pattern is this. Nearly every major scandal had multiple chances to be stopped. Analysts raised concerns. Accountants highlighted inconsistencies. Whistleblowers tried to speak up. Yet the machinery around them, lawyers, executives, compliant regulators, quietly swallowed their voices. Silence was more profitable than truth. Story after story follows the same arc. A fund appears too successful. A bank posts perfect quarters despite market turmoil. A firm claims to have eliminated risk entirely. Behind the scenes, the numbers are manipulated, losses buried, trades misreported. Eventually, someone notices. A young analyst questioning an entry. A compliance worker finding an anomaly. But by then the system has already moved to protect itself. Scandals did not survive because they were too brilliant to uncover. They survived because they were too lucrative to expose. Billions were siphoned from pensions, savings accounts, retirement funds, municipal budgets. Ordinary people paid the price, while institutions hid behind settlements, sealed documents, and phrases like unforeseeable market conditions. In Story 1.1, one truth becomes impossible to ignore. Wall Street does not hide scandals after they happen. It hides them while they are happening. It buries them in paperwork, scatters them across subsidiaries, encrypts them inside offshore partnerships, and erases them through non-disclosure agreements signed at midnight. And every time a scandal finally collapses into public view, it is because someone at the bottom, not the top, refused to stay silent any longer. Wall Street learned early that the best scandals do not start with noise. They start with silence. Private dinners, quiet hallways, whispered deals between men who never appear in public together. This was the second layer of the billion-dollar deception, the hidden networks behind every financial crime. If the first layer was greed, the second was choreography. Every collapse had a conductor. In 1992, a small group of investment bankers discovered how to move losses off balance sheets by building a maze of shell companies. On paper, each firm looked harmless, but in practice, they created a tunnel system where money vanished and reappeared like smoke. Regulators knew something was wrong, yet every document they received looked perfectly clean, because the real signatures, the real orders, moved through private couriers and unregistered mailrooms. It was not fraud by accident, it was fraud by architecture. Behind those transactions were people with real faces, real fear. One junior analyst, pressured to sign a valuation he knew was fake, later said, "It felt like I was signing away someone else's future every day." He wasn't wrong. Pension funds, school budgets, retirement accounts, all were quietly drained to inflate quarterly profits that never existed. The victims never met the perpetrators. They only met the consequences. By the late 2000s, this shell company playbook evolved into something more industrial. Offshore service firms in Bermuda, the Caymans, and Luxembourg specialized in opacity engineering, creating ownership structures so complex even their creators couldn't fully map them. Some companies changed hands 20 times in a single year, not for strategy, for fog. Journalists tried to trace the networks, but documents hit dead ends. Missing pages, sealed subpoenas, shredded attachments. A former paralegal later confessed that she destroyed 23 boxes of internal memos the night before a federal raid. She said the order came from someone above everyone else. But the shell game wasn't only about money. It was about immunity. The same executives who engineered the fraud were protected by private legal teams that operated like shadow governments. Settlements were negotiated in secret hotel rooms. Whistleblowers were paid to vanish. Files disappeared with no explanation except clerical error. And yet, every system has a fracture point. One misfiled email, one employee who refuses to sign, one investor who starts asking the wrong questions. The shell network was built to be untouchable. But history shows, the bigger the illusion, the harder the fall. By the time the shell companies were fully operational, the final tier of deception had already begun, concealing the collapse itself. Scandals on Wall Street never start with explosions. They start with small fluctuations, small inconsistencies, small anomalies that only the insiders notice. But insiders were trained to ignore them. Bonuses depended on silence. In 2007, an asset manager discovered that a major portfolio supposedly worth billions contained almost nothing real. The positions were inflated with circular trades, synthetic valuations, and assets priced using models no one outside the firm had ever seen. He raised the alarm to his superiors. They shut the door, lowered their voices, and told him the losses would self-correct. They didn't. Families began feeling the cracks before the headlines did. Mortgage letters tightened. Savings accounts drained faster than expected. Retirees noticed missing payouts and delayed statements. Every missing dollar was absorbed into the machinery of hidden liabilities that executives kept feeding, hoping the numbers would magically realign. Meanwhile, in closed conference rooms, lawyers and strategists tried to engineer a controlled landing. They rehearsed scripts for regulators, drafted settlements before the collapse even became public, and coordinated talking points between multiple firms. A whistleblower later testified that 3 banks rehearsed the same denial speech for weeks, preparing for a front that looked unified and unbreakable. But the markets were already trembling. Offshore entities stopped sending payments. Shadow funds couldn't roll over debts. A single European office accidentally sent out an email, revealing the network of internal guarantees that were never disclosed to investors. That email leaked. It was the first crack that couldn't be sealed. Investigators moved fast, but the documents moved faster. Some boxes vanished entirely. Others reappeared in altered form. A junior archivist admitted he had been told to sanitize certain files to remove any trace of executive approval. Another said she watched a senior partner walk out with 2 briefcases full of original ledgers and never return. When the collapse finally hit the public, it appeared sudden. But inside the system, it had been unfolding for years. What made this scandal different was the scale of the silence. The people who could have stopped it were the same people who had the most to gain from keeping it alive. And as history has shown, every illusion survives exactly as long as its architects remain loyal. The moment one defected, the moment the truth slipped through a single unguarded channel, the entire structure fell, not because it was weak, but because it was built on borrowed time. Every scandal on Wall Street may feel new, but history has staged this drama many times before. The faces change, the cities change, the currencies change. But the architecture of deception remains remarkably similar across centuries. In Rome, tax collectors forged ledgers to cover shortages. In medieval Europe, kings debased their own coins to finance wars. In the British Empire, colonial administrators skimmed trade revenues beneath layers of bureaucratic fog. The methods evolve, but the moral breach stays constant. The modern billion-dollar scandals echo these ancient fractures. Shell companies today resemble the shadow merchants of the Renaissance, who moved gold across borders using coded letters. Collapsing mortgage portfolios resemble the Dutch tulip contracts, promises backed by illusions. Even the offshore accounts, hidden behind 20 layers of incorporation, mirror the private chests nobles used to hide war debts from their monarchs. What makes the comparison striking is not just the similarity in tactics, but the repetition of consequences. Ordinary people always feel the first shock waves. Families losing homes, retirees watching savings evaporate, workers facing sudden unemployment. Across eras, the public pays for the elite's secrecy. The Roman Empire suffered inflation so severe that citizens abandoned currency entirely, reverting to barter. Modern households, facing collapsing pensions, cut back on healthcare, education and food, the quiet modern form of economic retreat. The emotional cost is the same: distrust, fear, and a growing belief that the system was never built for them. Even governments echo these patterns. Medieval kings responded to financial collapse with new laws that mostly protected the powerful. Today, settlements allow corporations to walk free without admitting wrongdoing, while communities wait decades for restitution that never arrives. The legal language changes, but the moral story does not. The parallel becomes clearest at the moment of collapse. Whether it was the downfall of a Roman treasury, a failing medieval mint, a British colonial bankruptcy, or a modern investment bank, the end always came when silence broke, when one scribe, one clerk, one accountant refused to comply. History suggests that financial systems collapse not when they run out of money, but when they run out of truth. And in every era, the truth is revealed not by the architects of deception, but by the individuals who can no longer bear its weight. The world may forget their names, yet their defiance becomes the hinge of history. When we strip away the numbers, the scandals, the filings, and the settlements, one truth remains: every financial crisis is ultimately a moral crisis. Markets do not collapse because money disappears. They collapse because integrity does. When trust breaks, everything built on it fractures, quietly at first, then all at once. History shows that the damage of a billion-dollar scandal does not end inside boardrooms. It bleeds outward into neighborhoods, classrooms, retirement homes, grocery stores, and kitchen tables. The most sophisticated frauds always land hardest on the most ordinary people. And the cruel irony is that those who engineered the collapse rarely touch the wreckage. The Roman treasury fell when a sequence of small lies became a culture. Medieval mints failed when short-term gain overshadowed long-term duty. Colonial empires imploded when exploitation hollowed out their economic foundations. The pattern echoes today. Every financial disaster begins with someone deciding that bending the truth is easier than confronting it. The public rarely gets an apology. They get headlines, hearings, promises of reform, and a long silence afterward. Meanwhile, families adjust to smaller paychecks, reduced healthcare, limited schooling, and a future that feels increasingly unpredictable. Confidence fades not only in banks, but in institutions, leaders, and the idea that fairness still exists. Yet history also offers a different thread. The individuals who refused to stay silent, a clerk who documented discrepancies, a whistleblower who revealed misconduct, a regulator who rejected a settlement, a historian who preserved the evidence others tried to bury. Progress is built on the accumulation of their defiance. What turns a scandal into a turning point is not the magnitude of the crime, but the willingness of society to confront its roots. When people demand accountability, systems slowly reshape themselves. When they stay silent, corruption becomes the architecture. The final lesson is simple and uncomfortable. Money is not inherently moral or immoral, but the systems we build around it reflect our collective ethics. Every crisis forces us to choose which values we protect and which we abandon. And when future generations look back, they will not ask how much wealth we created, but how much truth we preserved. Because truth, not capital, is the real foundation of any financial system. And when truth collapses, the balance sheets just follow.